Listen to me very carefully, because I'm only going to say this once. Gold went from $35 to $850. Then it went from $250 to $1,900. Then from $1,050 to nearly $4,800. 3 explosions, 3 separate generations of investors. And every single time, not most of the time, not when the stars aligned, not when some hedge fund wizard got lucky, every single time, 4 specific signals appeared. First, the same 4, in the same order, like clockwork, like gravity. And right now, in the year you are sitting there watching this video, all 4 of those signals are active simultaneously. So you have a choice. You can sit there, comfortable, doing nothing, and watch this happen to someone else again. Or you can wake up right now and do something about it. The clock is already running. Before we go any further, I want to make you an offer that would cost you thousands of dollars in any decent financial education program. I have put together a complete research report. The 4 signals, the historical data, the frameworks, everything I'm about to walk you through, and it is yours completely free the moment you subscribe to this channel. 40,000 people have already made that trade. They gave me a click. I gave them knowledge worth real money. Subscribe now, hit the bell, and come get what is yours at the link in the description. Let me start with signal number 1, and I want you to pay close attention here because this is the one that most people think they understand and almost nobody actually does. The signal is not simply that government debt is large. Every armchair economist on the internet will tell you the debt is too big, and then they will go back to doing absolutely nothing about it. No, the signal, the real, historically proven, mathematically precise signal is when government debt crosses a threshold where it becomes impossible to repay. Not difficult, not uncomfortable, impossible. And that is a very specific line. And the United States crossed it a long time ago. Let me give you the numbers, because numbers do not lie and feelings do not pay your bills. In the early years of the Great Depression, after the First World War had already stretched American finances to the breaking point, the U.S. government found itself staring into a fiscal abyss. They could not tax their way out. The economy was in free fall, unemployment was catastrophic, and the tax base had essentially evaporated. They could not grow their way out either because there was no growth. There was only debt and the political pressure to do something about it. So what did Franklin Delano Roosevelt do in 1934? He did what governments always do when math beats them. He changed the math. He signed Executive Order 6102, confiscated private gold from American citizens, did not ask Congress, did not hold a referendum, just signed his name and took it. And then he revalued gold from $20 an ounce to $35 an ounce overnight. That is a 69% increase on gold he had just stolen from the American people. That is not a financial policy. That is a heist conducted in broad daylight wearing a suit and tie. Now fast forward to 1970, America had been writing checks that the economy simply could not cash. The Vietnam War, the Great Society spending programs, the expansion of federal government in every direction. All of it was being funded with dollars that were supposed to be backed by gold, but the gold simply was not there to back them. The debt spiral was the trigger then, just as it was in 1934. And what happened to gold during that period? It went from $35 to $850 over the following decade, a 2,300% move. If you had simply recognized the debt signal and acted on it, you would have turned $10,000 into $230,000, doing essentially nothing except holding a position. Then look at 2000 to 2008. The dot-com collapse wiped out trillions in paper wealth. Then came Iraq, then Afghanistan, then the full machinery of post-9/11 military and domestic spending. And when the housing market imploded and the banks came crawling to Washington with their hands out, the government did not hesitate. They backstopped the banks, the insurers, the mortgage companies, every institution that had spent a decade building a financial weapon of mass destruction and pointing it at the middle class. U.S. debt essentially doubled in a few years, and gold went from $250 to $1,900. The debt signal fired, and gold responded exactly as it always has. Today, the U.S. national debt is approaching $40 trillion. That number is so large, it has become almost meaningless to most people. So let me make it meaningful. That is approximately $300,000 per household. The median household income in America is roughly $80,000. You are being asked, not asked, you are being assigned a debt burden that is almost 4 times your annual income, on top of everything else you owe. And it is growing faster than the economy can possibly grow to cover it. There is no scenario, none, zero, mathematically impossible, in which that debt gets repaid, which means signal 1 is not coming. Signal 1 is already here. It has been here, and the consequences are already in motion. Signal number 2 is the one that makes people angry when they finally understand it, because it reveals something deeply uncomfortable about the relationship between a government and its citizens when money is involved. When the debt math breaks, governments do not announce defeat. They do not hold a press conference and say, "Ladies and gentlemen, we have been irresponsible, and now we are going to restructure the monetary system at your expense." They do it quietly. They do it in technical language. They do it in August on Sundays when you are not paying attention. And then they tell you it was necessary, it was temporary, and it was for your own good. FDR did not just revalue gold in 1934. He made it illegal for Americans to own gold. Think about that sentence for a moment and let it land. The government of the United States of America criminalized the ownership of real money. If you were caught holding gold coins or gold bars after Executive Order 6102, you faced a fine of $10,000, which would be the equivalent of roughly $200,000 today, or 10 years in federal prison. The government did not debate this. They did not offer a buyback program with fair market value. They set the price, they took the gold, and they threatened prison for noncompliance. That is not monetary policy. That is the behavior of a government that has decided the rules no longer apply to it. Then on August 15th, 1971, and I want you to notice the timing because it matters. On a Sunday in the middle of August, when the entire country was on vacation, Richard Nixon went on national television and announced that he was temporarily suspending the convertibility of the US dollar to gold. He did not say the Bretton Woods system was collapsing. He did not say the Federal Reserve had been printing dollars without the gold reserves to support them. He said temporarily. It has now been 55 years. The dollar dropped 30% over the following decade. Gold went from $35 to $850, and the people who were holding dollars, who trusted the system, who believed the rules would stay the same, they got absolutely destroyed. After 2008, the rule change was even more sophisticated, because by then the government and the Federal Reserve had learned that transparent rule changes cause panic. So they invented new language. They called it quantitative easing. It sounds technical, it sounds responsible, it sounds like something a committee of very serious economists developed over many months of careful study. What it actually means is that they printed trillions of dollars from nothing and used those dollars to buy the toxic mortgage-backed securities that the banking system had spent a decade creating. They bailed out the people who caused the crisis using money that did not exist, and they called it a policy tool. Gold went from around $700 to $1,900 while they were doing it. And today, right now, the rule change is happening again. And almost nobody is talking about it in plain language. The United States government has passed the Genius Act, which requires stablecoins, digital currencies that millions of people are now using to be backed by U.S. government debt. They have used regulation to force the crypto ecosystem to become a buyer of American debt. At the same time, they are cutting interest rates while inflation remains elevated, which is the opposite of what every economics textbook on earth says you're supposed to do. They are changing the rules across multiple channels simultaneously. And because it is complicated and boring and does not fit into a headline, most people are not noticing, but the pattern is identical to every prior episode. Signal 2 is active. The rules are changing right now. Signal number 3 is the one that hits you in your actual life, not in a history book or an economics paper, but in your bank account, in your grocery bill, in the gap between what you earn and what things cost. And it is the signal that most ordinary investors feel before they intellectually understand it, which means by the time they act on it, much of the move in gold has already happened. So I want you to understand this one with precision, because precision is what separates investors who build wealth from investors who merely watch wealth transfer from their accounts to someone else's. The signal is negative real interest rates. That is the technical term. What it means in plain language is that your savings account is losing you money even when the balance is going up. Here is the arithmetic. And I want you to do this math yourself after this video because it applies to your specific situation. Your bank pays you, let us say, 3% interest on your savings. That sounds reasonable. That sounds like your money is working for you. But inflation, real inflation, not the sanitized government figure, but the actual increase in the cost of groceries, rent, gas, insurance, healthcare, everything you actually spend money on is running at 6, 7, 8% or more for millions of American households. So your $1,000 becomes $1,030 in the bank. But the purchasing power of that $1,000 has dropped by $60 due to inflation. Your balance went up. Your wealth went down. You lost $30 in real terms by being financially responsible, by saving, by doing what every financial advisor, every parent, every personal finance book told you to do. This is not an accident. It is a mechanism. When governments run debt that cannot be repaid and change the rules to extend the game, One of the primary tools they use is financial repression, keeping interest rates below the rate of inflation, so that the real cost of that debt erodes over time. They are not paying back the debt, they are shrinking its real value while you hold dollars that are shrinking with it. After Nixon's move in 1971, inflation climbed to 14%, while savings accounts paid far less. After 2008, the Federal Reserve took interest rates to essentially zero and held them there for years, while inflation crept upward. Pension funds holding treasury bonds were being promised real returns below zero. The government was literally telling retirement accounts, "Lend us your money and we will return less purchasing power than you gave us." And it worked, because most people did not understand what was happening until it was over. During that post-2008 period of near-zero interest rates and creeping inflation, gold went from $800 to $1,900. The people who recognized that their cash was being systematically devalued and moved into hard assets were rewarded. The people who sat in savings accounts and money market funds got robbed politely and legally. Right now, the Federal Reserve is cutting rates while inflation remains persistently elevated. Real interest rates are negative. Again, your cash is melting. The people who own assets, gold, real estate, productive businesses are getting richer. The people who hold cash are transferring their wealth to the asset owners. Without realizing it is happening, signal 3 is not approaching, it is already executing. Signal number 4 is the one that, when you fully understand it, should make the hair on the back of your neck stand up. Because signal 4 is not retail investors figuring out what is happening. It is not hedge funds making a macro bet. Signal 4 is the central banks, the institutions that actually print the money, the people who are supposed to be the custodians of the monetary system, buying gold with both hands. When the people who manufacture the currency are exchanging that currency for gold, you need to ask yourself one very serious question. What do they know that they are not telling you? Before 1971, when the Bretton Woods system was still technically intact, but increasingly strained, the cracks were already visible to the central banks of France, Britain, and Switzerland. They could see that the Federal Reserve was printing dollars without the gold reserves to back them. And so they did what rational institutions do when they see a currency being debased. They convert their dollar holdings into gold as fast as the system would allow. They were not speculating. They were not making a macro bet. They were getting out of a burning building before the fire spread to the exits. The Nixon shock was not a surprise to the central banks. They had been reading the writing on the wall for years. After 2008, something even more significant happened. For decades, central banks, particularly in Europe, had been net sellers of gold. They were reducing their gold reserves and holding dollars and dollar-denominated assets instead. That changed in 2009 and 2010. Central banks flipped from net sellers to net buyers for the first time in decades, and they have not stopped. They have been net buyers of gold for 15 consecutive years. In 2025 alone, central banks purchased almost 1,000 tons of gold. Poland, China, India, Turkey, Kazakhstan, the Czech Republic, these are not fringe economies making a desperate bet. These are serious national institutions making a deliberate, sustained, multi-year decision to reduce their exposure to the US dollar and increase their holdings of gold. Goldman Sachs. And I do not say this to endorse their projections. I say this to illustrate the institutional consensus, has called this the most aggressive central bank gold buying cycle in modern history, and has projected gold reaching $5,400 by the end of this year. Now think about what that means structurally. The demand for gold from central banks alone is enormous and sustained. At the same time, gold mining production is not growing at a rate that comes anywhere close to meeting that demand. The supply is essentially fixed in the short term. The demand is growing from the most creditworthy, most institutionally serious buyers on earth. And retail investors, ordinary people like the ones watching this video, have barely begun to move into gold in any meaningful way, which means the signal for a dynamic, the institutional accumulation phase, is happening before the mass retail participation phase that historically has driven the final, most explosive leg of every major gold bull market. The professional money is already positioned. The question is whether you will be positioned before the retail crowd figures it out and drives the price to levels that make entry much less attractive. Now I want to talk about how a rational, mathematically literate investor actually positions for this environment. Because this is where most people go wrong in one of two directions, and both of them will cost you money. The first mistake is doing nothing. I have walked you through 4 signals that have appeared in sequence before every major gold move in the last 100 years. They are all active simultaneously right now. Doing nothing is not a neutral decision. Doing nothing is a decision to stay in cash and bonds while those assets are being systematically devalued. You are not being safe. You are being robbed slowly, and you have chosen to stand still while it happens. The second mistake is going all in, becoming a gold evangelist, selling everything and putting it into one asset class because someone on the internet convinced you it was the trade of the century. That is not investing. That is gambling with a narrative. And narratives do not protect you. When gold drops 47% over 2 years in the middle of the biggest bull market in modern history, which is exactly what happened between 1900, 1974, and 1976. The 1970s bull market in gold ultimately produced a 2,300% return. It also produced a stomach-churning multi-year drawdown that wiped out everyone who was over-leveraged, over-concentrated, and under-disciplined. Position sizing and risk management are not the exciting parts of this conversation. They are the parts that determine whether you actually capture the move or whether you get shaken out at the worst possible moment. So here's the framework I use, and the one that I think applies to most investors in this environment. A diversified portfolio should still carry a significant allocation to equities. I would say 50 to 60% for most people with a multi-decade time horizon, because productive businesses generating real earnings are the engine of long-term wealth creation. Real estate, if you have the capital and the sophistication to manage it properly, belongs in the mix. Bonds are more complicated right now because the real return on most fixed income is negative, but some exposure makes sense for liquidity and rebalancing purposes. And then there is the metals allocation, which in a normal environment might be 5 to 10%, but which in this specific macro environment, given all four signals firing simultaneously, I think warrants moving toward 15% for most investors. Within that metals allocation, you have choices, and they carry meaningfully different risk-reward profiles. Physical gold is the most conservative. You own it, you store it, it does not go to zero. It does not have counterparty risk, and it tracks the gold price directly. A gold ETF like GLD gives you the same price exposure without the storage burden. It sits inside your brokerage account. It can live in a retirement account, and it is liquid enough to exit quickly if your thesis changes. And then there are gold mining equities, which are the leverage play on the gold price. Here is the mathematics of why miners amplify the gold move, because this is not opinion, it is arithmetic. If a mining company pulls an ounce of gold out of the ground for $1,200 and the gold price is at $4,800, their profit per ounce is $3,600. If gold moves up 25% to $6,000, their cost of production stays at $1,200. Their profit per ounce jumps to $4,800. That is a 33% increase in profit from a 25% increase in the gold price. The leverage is built into the business model. Higher risk, higher potential reward, and an absolute requirement for careful position sizing, because miners can and do fall hard and fast when the gold price corrects. The other critical discipline is not treating this as a one-time decision. The signal framework is telling you that the macro environment favors gold. It is not telling you that gold will go straight up without interruption. It will not. It never has. The investors who win in these environments are the ones who establish a position, size it correctly relative to their overall portfolio, and have the discipline to hold through the inevitable corrections without abandoning a thesis that the underlying data continues to support. If the four signals are still present, and right now every single one of them is the position is still valid, if the signals begin to reverse, you reassess. That is how you invest, not with emotion, not with conviction that becomes religion, with data, with discipline, and with a framework that has been tested across a century of monetary history. Let me leave you with this, and I want you to sit with it for a moment before you click away. In 1971, when Nixon ended the gold standard on a Sunday afternoon in August, the people who understood what had just happened and acted on it turned modest positions into life-changing wealth over the following decade. The people who did not understand it, or understood it and did nothing, watched their savings slowly erode while gold ran 2,300%. In 2008, when the Federal Reserve launched quantitative easing for the first time and central banks began their historic pivot to gold, the same dynamic played out. Two groups of people, same information available to both, completely different outcomes. Right now, you've just watched me lay out four signals, debt beyond the point of repayment. Rule changes already in motion, negative real interest rates already in place, and the most aggressive central bank gold buying in modern history, simultaneously active for the first time in decades. You are not watching this in hindsight, you are watching it in real time. The only question that matters now is which group of people you are going to be. Go do the work, go build the position, Go get the free research report at the link in the description and stop watching other people get wealthy from patterns that were visible to anyone paying attention. So that is all I've got for you. Now go.